Hi, Dave Cotter again with Hybrid Debt Fund CEO, here to continue the series of education around private credit. And today we're going to be talking about ABL financing. What is that? Asset-based lending. It's a form of secured lending where loans are backed by the borrower's assets. So think about accounts receivable, inventory, equipment, or real estate as well. If a company has strong collateral but might not have the perfect financials, happens from time to time, or consistent cash flow, ABL can provide a flexible and scalable credit solution. So think of ABL as credit with a collateral swagger. If you have the assets, guess what? You have the options. So who uses ABL? ABL is commonly used by middle market companies, call it 10 to 500 million in revenue, companies in manufacturing, wholesale distribution, logistics, or retail are just some of the examples. Businesses undergoing rapid growth turnarounds or seasonal cash crunches. Private equity firms and family offices also use ABL as part of their capital stack to juice up the returns or bridge complex transactions. Fun fact, over 465 billion with a B in asset-based credit facilities are active in the US. Just that alone, that's a lot. So what's the structure like? ABL structures vary, but here's the typical framework. So revolving line of credit based on a percentage of the eligible AR, accounts receivable, usually up to 80 to 90%, and inventory up to maybe 50%. So they're purchasing all those things and throwing it in the warehouse. Term loans against hard assets like machinery or real estate. They're typically covenant light. They're more flexible than traditional cash flow loans. Loan advances are, generally speaking, formula driven, meaning as assets fluctuate, so does your borrowing base. So more assets, guess what? More availability. Pros and cons. Well, the pros are scales with growth. So more sales equals more receivables equals more capital. Easier access than traditional bank loans. There's fast execution. ABL lenders move faster than commercial banks. Covenant light or even non-recourse. You don't have to sign personal guarantees in some cases. Here are the cons. Monitoring overhead, regular audits and reporting required. There's availability risk. So if the asset drops, guess what? So does the borrowing power. Higher costs than traditional loans, but cheaper, quite frankly, than equity. And a little tip, ABL is ideal when asset quality is strong, but cash flow is lumpy or in transition. So what are the risks and the returns for investors from a private credit investor lens? So think about this. Risks, collateral volatility, especially inventory-heavy businesses. There's fraud risk. If asset reporting is weak, liquidation can be messy if the lender needs to enforce it. Returns, typically ABL yields ranges from anywhere from 8 to 14% depending on the collateral and structure. So add in fees, exit premiums, and warrants, and the returns can certainly be boosted a little bit further. Pro insight here, smart ABL structures offer equity-like returns with, quite frankly, debt level risk if you underwrite well. A couple of fun facts as well. ABL is the credit world's Swiss Army knife. It's versatile, it's dependable, and saves the day when traditional tools fall short. Many of the biggest retail and manufacturing turnarounds in the last 20 years started with ABL. In Q1 2024, over 30% of the middle market financings included some form of ABL, up to 12% year over year. So final word, asset-based lending is not just a distressed solution anymore. It's become mainstream. Strategic tool for growing companies and savvy lenders alike. So if you're in private credit, ABL deserves a place certainly on the radar. It's the hidden gem of the debt world, tangible, tactical, and tailored for real business needs. So you got collateral, then you've got capital. So that's your education today in the private credit world when it comes to ABL.